Yo, what is going on, you guys? Welcome back to another trading market recap. Today is Sunday, May 31st, last day of May. We had an insane trading week in the month of May. Honestly, it was insane. We had tech earnings, we had Nvidia earnings, we had the ceasefire take impact. We had Kevin Warsh be finally elected as the chairman of the Federal Reserve. A lot of volatile moments in the month of May. Overall, closing off, very aggressively. We had SPY at all-time highs, AMD set record highs, Nvidia, slowly climbing back up, Tesla shooting for the skies, Coinbase taking off, Clarity Act was passed as well in the month of May. Month of May was kind of a good kind of end to, I guess you can say, kind of the beginning of Q2, right? It was a good start, I guess you should say. We're not kind of towards the end. We're about to end it up. But today we're going to go ahead and recap one trade that I went ahead and did today. On May 15th. This one's a little bit late, guys. This is before the loss of the 1.6K. But I really just want to be able to produce this content, get it out there, track every single win, at least to the best of my ability, to just kind of document more and have more content here on the channel with you guys. So this specific trade was kind of a little bit of a tricky one. This was a concept that I want to share with you guys that honestly has helped me in being more profitable. There's a term out there. It's a kind of a concept, a saying. It says fade in and fade out of your trades. So what this kind of means is like enter small and then kind of add more if it goes good, or if you begin to kind of draw down at some sort of support, you kind of catch like some sort of a bottom, right? Then you add more, and then when you're getting out, instead of just closing your position all at once, you take some off the table. So you go in kind of easy and you come out kind of easy. For the vast majority of my trading career, I've been just maybe like 20-30% of my portfolio, very aggressive, very heavy, and I'll try to, so there's two kind of paradigms to trading. You can expose low capital, expect a high percentage return, or you can expose high capital and expect a low percentage return. Why? Because when you expose, let's say $100 and it makes you 100%, or let's say something realistic, right? Let's be realistic here. $100 and it makes you 50%. And that's only $50. For the vast majority of you guys that are living day-to-day lives as grown adults, paying for your own bills, your own rent, your own cars, your own insurance, $50 is something you kind of wipe your ass with. You're not going to be too happy to sell that, right? It's not, oh, wow, I'm rich, I made $50, right? But now let's switch this paradigm. I've kind of talked about this a little bit here on this channel. If I were to expose $1,000 in one trade and it does 50%, that's $500. For some people out there, that's like 2 days of work, that saved them a whole 16-hour shift, 16 hours of their life just on the side, right? They have their jobs, they have this little side gig here trading, and boom, adds extra income to actually pay a bill, pay your car note, right? So that's, for the vast majority of my trading career, that's how I've approached the market. Big capital, 2,000, 6,000, 5,000, 6,000. You guys have seen my trading losses. Back in Microsoft, I have a trading loss here where I lost 5,600 in just one trade. I just lost 1.6K last week that we just finished up. I play big capital to make big returns. Why? Because we're living. You want to make 600, 700 a day off of this to be able to, hey, sustain yourself and progress in life, right? Achieve the finer things. And that's what all of you guys kind of desire. And I don't want to kind of share this with you guys so you go down the path thinking, oh, damn, I got to expose high capital to make a lot. If Jerry does it, I got to do it. No, I honestly suggest you go through your learning curve, exposing as little as you possibly can. Don't learn the $100 lesson losing $1,000 is what I tell all my students, because it's true. Like, you're gonna make mistakes, and if you make those mistakes with $1,000, you're gonna be a lot more emotionally distressed and kind of like, I guess, you're gonna feel that. It's gonna be a lot more of a negative impact on you to lose such significant amount of money to you compared to just something small that you could actually afford to lose. Now, on the gain side, right, taking profits on these small numbers isn't necessarily the greatest. So it's a sacrifice at the beginning when you're really just learning, timing your entries, setting your technical analysis, finding out which part of the market you want to enter, whether it be market open or near the close, or trade supporting consolidation, or As you begin to develop more experience, you'll see what I mean. So this trade, I had multiple entries. I had one right here. That one was the first contract entering at 643. I had another one right here. So I'll show you guys all the entries here. We had 1, 2, 3, and 4. So 1, 2, 3, and the fourth, actually 5 entries here where I enter multiple times on this trade. So let's start with the traditional. What did we make? SPY 743 call May 5th, May 15th, bringing home a whopping, let's go ahead and get that on the screen, $2,019. So we did enter this position, right? The sell, you guys could go ahead and see there, it's at 7:16 a.m. Market opens at 6:30, so that means we closed this trade in roughly 45 minutes from market open. And my initial purchase when I first started this position was at 6:40. So 6:40 to 7:43, right? That was about an hour. Wait, holy crap, that can't be right. 6:40 to sell at, hold on. 6:40 to sell at 7:16. Holy crap, that's even better. So 6:40, that's 10 to 6:50, another 10 to 7. So this is a 30-minute trade, roughly, maybe 36 minutes, right? Don't get technical with me, we're just rounding it up. But about 36 minutes to close up this trade to make $2,000. And this was how I introduced to you guys the theory of fading in and fading out. So all these entries mark a different amount of capital. So I'll show you guys the buys here. You know, I'll show you guys here on the camera, but I'll also bring it up over here. So one contract started the position right there. You can see my initial cost of that contract being, what is that, 80 bucks? Yep, limit price, 0.80 right there. That was the first contract. So that position, I didn't add more to it, right? Let's go ahead and break down the charts here as well, not just the entries. You know, I'll show you guys the things, the entries, the logs later, all the adding the contracts and buying more. Breaking down a little bit to my thought process when we jumped in this trade. So first off, I'm going off of previous levels. SPY oversold on Thursday going into Friday, kind of on that news of, I think it was more so the ceasefire going into the end of the week, and we had a big dip, but I was very bullish after this dip because of how aggressive SPY has been, given AMD's run, tech earnings, Apple, Microsoft, Google going for all-time highs, Amazon going for all-time highs, had a very positive impact on SPY in the last, you know, kind of mid-May. So once we had this drop, I didn't expect to start the sell-off just yet. There wasn't really negative components out there. We still have a ceasefire in effect. Yeah, we've seen kind of a little bit of inflation with the PCE report, but it wasn't too negative yet. So I knew we had NVIDIA earnings coming up, so I was still very bullish on the market. So when we began this trading day, I just refreshed my screen, so we gotta go back to May 15th. Right here. When we began this day, I knew that the selling was already kind of happening. It was an oversold scenario. We closed that market 747, opened at 738. It's a huge amount to go down, especially in the S&P. So I was like, okay, we're in an oversold scenario, and at the beginning of market open, I usually, for the most part, try to wait. I try not to jump in the market too early, but this one, I was very kind of confident in this oversold scenario. Look how big of a sell-off that is, that gap down. You know, that's aggressive for those of you guys that are brand new, you know. When you identify oversold scenarios, oftentimes there's people that come in and buy these things at very cheap prices because they perceive it as a deal. You know, if I told you the new iPhone 16 Pro Max, right, when it comes out, hypothetically, right, for those that want to get technical, and when this iPhone comes out, it's worth $1,000, and let's say a week later, price drops significantly. Boom. And now it's worth, let's say, 200 bucks. Some people will buy this thing for the 80% off discount, and they'll hold it expecting it to hopefully go back to the value of $1,000, right? And that's the same kind of psychology that happens. You know, if you could go get the brand new iPhone 17 Pro Max for 200 bucks, you'd probably go and do it, correct? So many people do that. Oftentimes you got to be reminded that these people that buy these, you know, shares or assets, they don't buy to hold for the next week or 2 weeks. They're buying for generations, for the next 2, 3 years, 6 years, 5 years, 7 years. There's a lot of long-term investing going on. Hint the word investing. Investing is always going to be a little bit long-term. So SPY is always going to be a little bit more respected when it's oversold, and people will buy these dips. So I seen that aggressive oversold scenario, so I was bullish already, entering the day with a bullish bias. Once I established this bullish bias, I was like, okay, cool. Market open, we got the sell-off, came up, I caught my resistance level, marked that out right there at 740. And then once we caught lower, we came here and caught some support around 739, bounced up. I started my entry here right below the support. Caught that at this literally support, and I caught the first move. I was green, went positive like maybe 30%, but after that we continued to sell off. And we caught a lower bottom here. And I was entering, you can see I added some here. And then I finally caught this bottom over here on this one. You see right here, entered again at 648. I'll show you guys all of them. So once we caught the supply line down here, I was like, cool, that's the bottom right there at 738. Remember, why am I buying at 738? Psychological levels. Zeros, half cents, fives, tens. Know this information, bro, because around these levels, most of the times price is going to be respected around these whole numbers, these half dollars. It's something, I don't know, it usually holds up. And in pre-market, you can kind of tell, you know, that support I initially had traded initially, it was kind of similar over here to what we had on Monday, what we kind of held up on Wednesday. So I was pretty bullish going into today. And I was like, we caught that supply right there. Let's go ahead and, you know, add some more to the position. Later on, you know, as contracts began to break out of that supply line, we had the consistent resistance up here. You see, we kind of wicked up, didn't really hit it, but came down. And now the trend was still forming. Shaped up pretty aggressively, broke it. Once we broke it, I noticed something here. We didn't go back down to supply. We stopped at support. We never dropped this low to supply, signaling buyers accumulating. If buyers weren't accumulating, price would have fell from here down here, possibly even lower, because buyers have now stopped purchasing at this level. So showing now, you see the lower lows going into higher lows. That began to catch a support and signal for me to hold the trade a little bit longer. Keep in mind, it's 7 a.m. We're not in 11 a.m. We're not in 12 a.m. 12 p.m. We're not close to the bell. We're here, early market, 30 minutes in. Being in this awareness of where I'm at in the market is also very important for all of you guys as beginners. Be aware where you're at the market. If it's 30 minutes in, hey, there's a possibility, you know, especially given the last 2 days, right? In this specific scenario, being aware that the last 2 days were extremely bullish, boom, going for 735 all the way to a high of 743, going from an open of 743 all the way to a high of 749. These are aggressive rips, moves by SPY. Do I expect that to kind of slow down after a pre-market sell-off? There's a lot of retail buyers that are going to come in and step and, you know, purchase at these levels. Let's take this to the 1 minute again and then go back to May 15th. I hate that I have to do this. So once we caught these lows and I was remembering, you know, I'm early in the market, I seen us kind of break above this resistance, which was my true moment of truth right here. Is what I like to call them. Once we find these support levels right here, we started moving higher. We have a clear resistance up here. Look, price every time hits, reject, hit, rejected, kind of hit, rejected, went slightly above as an outlier, rejected, hit, rejected, until finally we broke above. So for me, my signal here on the take profit was going to be this market open high right here. That was where I wanted to draw the line at 741, technically 742, really at that high. But I knew around this level right here, I have to be conscious of taking my profits, not being too greedy. And sure enough, you know, I didn't hold it till then. I did get out at 7:16 a.m. So I did sell around 741.58 and just close the position. You know, I could have rolled it out for a little bit more in profit. But like I said, you know, looking at these levels here at this pre-market high or market open high, it's kind of where, hey, we broke above support once. You know, by the grace of God, we're up here now. You don't ever want to be too greedy and think it's going to go for 743, 7. You know, you got to be kind of conscious of the buying and selling as well. You know, with this kind of pushing up after an aggressive sell-off, it could also mean sellers trying to get out as well. Sellers trying to, hey, they missed the pre-market move, the after-hour sell-off. Some people, when they push this up, they, you know, have fear, or they maybe are just selling, you know, for the retirement and they think it's going to come down. So they'll pull that plug. They'll take their profits despite not being able to catch the bigger move. Hey, this come down right here is, you know, what's going to work for them. And they'll wait for the push up just to exit. So, you know, kind of recapping that trade, just sharing with you guys more so the fading in and the fading out. That's going to be very helpful for you guys on this trade market recap, understanding you don't have to go all eggs in one basket. Sure, entering at one contract, two contracts might not be the highest reward for your time on the trade, but at the end of it, very good at preserving your capital, minimizing that risk. You know, we entered at this trade, same strike price, same expiration, 1, 2, 3, 4, 5 times we entered this trade, just adding on to it. So that concludes how we made $2,000 in about maybe like 36-40 minutes. And I hope you guys enjoyed this market recap. Thank you guys for watching. Jerry Trades of SoCal Trading Group, over and out.